Hi everyone. Okay, it looks like everybody's here now. Good morning to you all. Thank you very much for joining us this morning and welcome to the K3 Hub. My name is Marie Wadeson and I'm a managing director here at K3 Advisory Group. And I also lead the K3 Hub, which sits at the heart of our relationships with the professional advisory community. We have got a jam-packed session this morning, so I am going to dive straight in. There should be a slide on the screen which tells you a little bit more about the K3 Hub in the meantime. Moving on to some housekeeping points. So you will have seen as you've joined the webinar, we are recording today's session. We will be putting it onto the K3 Hub website next week, so you can refer back. We are sharing a copy of a PDF of the slides in the chat. We will share that periodically throughout the session today, and we will circulate that after the session as well. The Q&A function is open, so please do feel free to ask questions as we go. I am going to be moderating the questions today, so if you would be kind enough to put those questions into the Q&A rather than the chat, that would just give me a hand as we run along. I know that having seen we have had a lot of questions in up front already. It may be the case that we're not able to cover everything today. If that is the case, I apologise up front. And what I'll do is I'll pass your questions to the relevant speaker and they will come back to you straight after the webinar. Okay, so on to the first part of the session today. We have two sessions of 45 minutes each, a VAT and employment update, and a session exploring why there is a gap between data and decision making in professional services firms. So, firstly, I'd like to welcome in that case my colleagues Damon Wright and Aaron Kendall, who are both from K3 Tax Advisory. Damon heads up the VAT team and has a wide range of experience. He advises all types of businesses from sole practitioners and proprietors to OMBs and large corporates on all areas of VAT, including VAT exemptions, recovery, liability, and compliance. And Aaron is an employment tax expert. He helps businesses remain compliant with their employment tax obligations and is a construction industry scheme specialist. He regularly delivers in-person training to clients. Right, I think over to you, and I think Damon, you are going first.
That's right. Thanks, Marie.
Right, thank you.
No worries. So we have a very quick run through of the VAT in the land and property, as this is a very complex area and it's one that often generates quite a few challenges. I will probably just be appraising the slides as I go through to keep within the time frame we've got, but you will get copies. So there's a reasonable amount of detailed information on there that you should be able to use as a follow-up. Great. So on to the first slide. Next slide, please. Thank you. So good place to start. When you look at the VAT legislation, with the supply of land and property, which generally is at least a supply of a right over land and property, the default position in the VAT legislation is that that supply would be exempt from VAT. There are, however, and the way the legislation works, any number of exceptions to this. In particular, the first freehold sale or grant of a major lease, which is 25 years or more, in a newly built, converted, or partly built residential or relevant charitable property, that supply can be zero rated. And that's important to note because being zero rated is a taxable supply, and that's very important for VAT recovery on associated costs. Also, the first sale, and it is only the sale, not the leasing, of a newly completed commercial building within 3 years from the date of completion is automatically standard rated. So that's automatically subject to VAT at 20%, as opposed to being VAT exempt. And again, if you're building new commercial, it's very important to have a clear idea in the early stages as to whether you intend to lease or whether you intend to sell, because that makes a big difference with regards to how you then treat the VAT position going forward, in particular recovery of VAT on the associated construction costs. Hence why we then come to the fact that a supply of land and property under an option to tax is standard rated. So that changes what would otherwise be an exempt supply to a standard rated supply. And that is typically used, but not only used, on commercial buildings that will be let as opposed to sold, or older commercial buildings that's going through a second sale or even a first sale if it's more than 3 years from completion. Because that, by making that supply under a positive option to tax, and we'll go on to how that works in a bit, um, by making it a taxable supply, that allows for VAT recovery on associated costs, including the construction costs. Then we have some specific exemptions from the exemption, which automatically makes the supply standard rated. And these are supplies of things like holiday accommodation, hotels, serviced accommodation, rent, camping sites, caravan sites, mooring facilities for boats, etc., etc. So if you are advising on any land and property transactions involving some of those, then it's important to try and pin down exactly what's being done and therefore which VAT, whether it's standard rated or exempt. A supply of sporting facilities gets more complicated, and I won't go into detail, but if you get involved in a supply of sporting facilities, depending on exactly how it is supplied, it could be exempt or it could be taxable, or in some circumstances, it can in fact still even be zero rated. And all of this automatically applies unless the sale forms part of a transfer of a going concern. And with regards to property, I will come back on onto that later. A transfer of a going concern is where a business is transferred from one entity to another, and it's an ongoing business at that point and will continue to be an ongoing business afterwards. But we'll go into more detail later. The other things important to note of VAT on the construction services often follow the liability of the main supply. So construction services for building new residential or relevant charitable properties can be zero rated. Again, if it's new. If it's a conversion, however, there is a reduced rate of 5% on some of the construction services. And if you're in those circumstances where there is a conversion from commercial, for instance, so you take a commercial building and you're going to convert it to flats, then a reduced rate can apply to the majority of the construction services, but not all. So it would be important to review those in detail. Next slide, please. So the following slide is really just a summary of all of that, just so that you've got a bit of a handy sort of memo to refer back to as and when you might need to. Next slide, please. Okay, so the other thing to try and then understand is we've referred to relevant residential and relevant charitable property. Well, what are they? That's generally any building that's designed as a dwelling, or any part of a building that's designed as a dwelling. Then that qualifies. Then you also have things like student accommodation, nursing homes, residential homes, care homes, etc., for children's care homes, adult care homes, etc. Armed forces, monasteries and nunneries. We like to put little bits in there like that just to prove how detailed the legislation can get. But yeah, they will qualify as relevant residential. And then charitable. I think if you're dealing with a charity that's undertaking property transactions, then I think the best thing to do is to try and go through the guidance that there is, because it is very, very specific and there are very specific conditions to be met. Just be aware that it can qualify for zero rating if those conditions can be met. So it is definitely worth looking at and being aware of. As I said, this can include conversions from commercial to one or more of the above, or even if part of the building is, but be aware of planning permissions and restrictions that can sometimes disturb the ability to zero rate a construction. So, for instance, if there are clear restrictions on the use of the building, then that can have a significant impact. So it is definitely worth being aware of that. Next slide, please. I mentioned before the option to tax then. So, that takes the default position of an exempt supply where potentially you get no right to reclaim VAT on any associated costs, to making it a taxable supply by opting to tax. And when we say, well, why would someone do that? It's exactly for the ability to reclaim VAT. on the associated costs. The way it is done is formally notifying the option to tax in writing to HMRC, and they do now retain full records of that, and it can be cross-checked later. And in fact, I've even had a client recently who disposed of a property without realizing there was an option on it. And when they went to deregister for VAT, the revenue wrote back and said, "We've got a record of an option to tax on this. What have you done with the property?" So it does go through. I understand from something coming out yesterday, funnily enough, that the revenue are looking for this to be a form of digital notification, which would only be great because that will make the whole thing hopefully easier to track and a lot faster to process. Land includes any buildings or structures permanently affixed to it. Property means land, including buildings and civil engineering works, and it also talks about the curtilage of a building. And an interest in property means any interest, right over or license to occupy. Funnily enough, you don't actually have to have an interest at the point in which you opt to tax. So I like to say I can always opt to tax Buckingham Palace. So should I ever acquire a right of land in any part of Buckingham Palace, then my option to tax would then kick in, unless by that point I've actually retracted the option. It's only effective, as I said, when the opter actually has the interest in the property. So that's quite important. And just because a landlord has opted a property does not mean a tenant needs to. An option to tax is very specific to the individual legal entity, etc., that has the interest in that land or property and then has the ability or wants to opt to tax in order to reclaim VAT on it. If your client or you are using a building that the landlord's opted on, but you're using it for business purposes and you are entitled to reclaim VAT, you can reclaim that VAT against your normal business activities. You do not have to opt to tax. Next slide, please. There's some more detail on what it does cover. I think the important things to pull out here is that if you opt to tax the bare land, it doesn't automatically then apply to any building that is then built on it, unless you notify the revenue that you want to extend the option to cover the building. If you opt to building, it doesn't automatically revert to the land if that building is then demolished. And the land is then supplied as bare land. Again, unless a notification is made to the revenue to say that the option to tax should equally apply to the bare land that is left. There is anti-avoidance legislation. It is a complex area, and I would always suggest that a lot of time is spent really with any business that's looking to opt to tax to really understand their long-term plans for a property in order to work out whether or not it's going to be cost effective to do this, and whether or not they're going to be caught by any anti-avoidance legislation, which could cause real problems. Next slide, please. So there are circumstances where once an option to tax is made, generally it's made, and it lasts forever and a day, unless there are circumstances in which it is revoked. The opter can revoke, but there are specific conditions to that. Generally, that's time related, and so it needs to be aware that in general, if I've opted to tax, that option to tax will last for 20 years unless there's an earlier cutoff point that allows me to revoke that option earlier. Otherwise, I won't be able to do it until at least 20 years past. If it also needs to be aware that certain purchases of land and property, such as charities, housing associations, etc., can actually actively disapply an option to tax made by the person that's trying to sell that land or property to them. And that's important, because that can change and have change the liability from what would otherwise be standard rated to exempt, and have real implications for historical VAT reclaims under the rules around change of intention of use, and also things like the capital goods scheme. So again, it's always important in any transaction for land and properties is to understand the status of the client, what their actions might be, and if commercial arrangements can then be made with them, if necessary, to retain an option to tax, um, to allow that. But if it's clear that the VAT shouldn't actually be a cost to them, they should be able to reclaim it. And they can generally be commercial discussions, really much more than they are a pure tax legislation one. Um, yeah, so and also where VAT is actually chargeable on a transaction, it can of course increase stamp duty land tax liabilities because that's calculated on the gross value. Hence why in some circumstances the purchaser or lessor of a property that's been opted um, may in fact want to try and see whether it can fall within the transfer of a going concern rules, and we'll come on to that in a bit, because that can mean that the transaction is free of VAT, which can also then reduce the stamp duty land tax liability. Next slide, please. I think I've set out on here, and it's one to follow up, but and I've mentioned about input tax recovery on it. Um, as you say, recovery of input tax on costs associated with the land and property will be directly linked to the use that that property is being put to and the VAT liability associated with it. Apart from, as I say, where if you're using it for trading purposes, then your ability to reclaim the VAT is linked to the taxable status of your trading activities, unless you sublet part of the property, all or part of it. If you do sublet all or part of it, part of the property, you will be making a supply of land and property, and your input tax will incurred against some or all of that property will then depend on whether or not your supply is exempt or taxable, based upon the conditions that we've set out above. Okay. I think the other thing to express, and I did mention it very briefly, is change of intention. So if you are building a building and the original intention is to develop, say, residential property, flats, apartments, this is a common area we come across, and the original intention is to sell or grant a major lease in the completed residential dwellings, apartments, etc. at the end of it, then that's going to be a taxable supply. VAT can be reclaimed on all of the costs. You can get zero rating on a lot of the costs as well, potentially. But if you then decide that for one reason or another, the market is such that you would rather retain ownership of the property and just enter straight into normal residential letting, then that will be an exempt supply, and that would be a change of intention at the time you make it, and that can have a clawback on VAT that you previously recovered. So it's important to remember that. Next slide, please. So yeah, so transfer of a going concern. Next slide, please. Just so that I can highlight. So a transfer of a going concern is, funnily enough, it's anti-fraud legislation. And so where it applies, so where the revenue consider it is a transfer of a going concern, they will say that it must apply, unless you can demonstrate for some reason that it doesn't meet all of the conditions. So normally the sale of assets of a VAT registered business or a business required to be registered is subject to VAT at the applicable rate for the sale of those assets. But if those assets form part of an active business, which you are then selling as a going concern, because you are selling the assets together with anything else that will allow the buyer to pick all of those assets up and run a business from it from the day after purchase, then it can be a transfer of a going concern. And a transfer of a going concern is in fact what they call outside the scope of VAT, but with the right to reclaim all of the VAT on any associated costs. And that can be important for retaining the right to reclaim VAT on historical costs. It doesn't matter whether the sale of assets would otherwise be VAT exempt or zero rated. as the TOGC conditions can still be met. And but it is important to be aware that where the asset is or includes property, then there are very, very specific conditions that need to be met. So yeah, I think if we can skip a couple of slides, I think there's a final one on one more, please. Thank you. Oh, sorry, my fault. I'm going a little bit too quick, but I'm trying to stay in time here. So this is a slide which sets out really the conditions for a transfer of a going concern to apply when there is a property which is the business asset that's being sold, um, and if there's already a property rental business, so there are tenants in there, then it can be a TOGC. Um, then as you say, there are these conditions, and it can qualify. You have to be aware that if the vendor has opted to tax that property, the buyer must also do so on or before the sale is completed or a tax point occurs. And that can be a tax point can be an earlier payment made to as a deposit, for instance, for the property transaction to go ahead, unless, of course, that money is paid into an escrow and is not available to the seller until completion. But so, yeah, it's important to understand there is the very, very specific rules about the timing of a buyer's option to tax, which if they don't do that at the right time, then the value of the property element of the assets being transferred under where the seller's opted to tax will automatically be standard rated. So yeah, so very specific conditions to follow. I think that's probably my time allocation. I do appreciate that was a very, very quick run through. I will happily pick up any questions when we can, or come back to people. But as I said, you should get a copy of these slides. So hopefully there'll be reference material you can revert back to, at least to give you a starting point before perhaps you want to ask for further advice. On that, I'll hand over to my colleague Aaron, who's going to cover off employment taxation, or in particular the construction industry scheme. Over to you, Aaron.
Thank you, Damon. Good morning, everyone. As Damon says, I'm from K3 Tax Advisory, and today I'm going to be looking at some of the key developments within the construction industry scheme, or CIS. I believe we've got a mixed audience on the call today, so what I'd like to do is give a bit of a practical overview of the rules, cover the recent changes that came into effect from April 26, and share some of the issues we're seeing when dealing with HMRC in practice. Given we've only got around 20 minutes, I'll keep things relatively high level, focus on the areas that are sort of generating the most questions from clients at the moment. So if we go on to the first slide, please. So if we start with a quick refresher, most people on the call will have probably come across CIS before, but it's worth sort of spending a minute or two reminding ourselves of what it actually is. So at its simplest, CIS is HMRC's way of collecting tax from certain payments made within the construction sector. Where a contractor pays a subcontractor to carry out construction work, there are also obligations around verification, deductions, and reporting. So one thing that tends to surprise people is just how wide the scheme is. It applies to most construction work carried out in the UK, and it can also even catch overseas businesses carrying out construction operations over here. And as we'll see shortly, it doesn't just affect businesses that think of themselves as construction companies. So if we can move on to the next slide, please. So when we talk about contractors within CIS, we're talking about businesses that engage subcontractors to carry out construction work. That's fairly straightforward in many cases, but the rules actually recognise two different types of contractor. So there are mainstream contractors, which are sort of the traditional construction businesses, and deemed contractors, which can include organisations that aren't generally associated with the construction industry. So one thing to remember is that contractors have a number of ongoing obligations under CIS, which include filing monthly returns with HMRC, but we'll come on to them shortly in a moment. Some people like private homeowners tend to fall out of the scope. So if some is simply having sort of an extension built on their own house, CIS probably won't apply. but there are some nuances to this. So if it's a private landlord with multiple flats, for example, and they were getting some extensions done or quite a lot of considerable work done, and they were looking to sell these once they were built, there's an argument that they would be considered sort of a property developer, and they would likely fall inside the scope. So it's not just a straightforward and clear cut. If we can move on to the next slide, please. So mainstream contractor. So this is where sort of what probably people think of when they think of the term contractor. So these are businesses that are actively involved in construction work or supplying labour for construction work. Might be a building company, a labour agency, or property developer, as we just spoke about, or something similar. The structure of the business doesn't matter. So it could be operating as a sole trader, partnership, or through a limited company. The important thing is the nature of the activities they're carrying out. If we move on to the next slide, please. So the other side of it, we have deemed contractors, and this is where things get a little bit more interesting. So this is the area that often catches businesses and advisors by surprise, because organizations might not consider themselves as part of the construction industry at all. But here we're sort of talking about businesses maybe like supermarkets, housing associations, local authorities, NHS trusts. That basically what the current test is, if you fall outside the scope of deemed contractor, is whether or not you've incurred more than £3 million of construction expenditure during a 12-month period. If so, you'll be a deemed contractor. We often see in practice is a business undertaking major development or refurbishment, and nobody's stopped and considered whether CIS obligations have applied because they don't see themselves as in that sector. Normally, it's not usually deliberately non-compliant. It's just simply no one realised that the rules applied, which catches people out. If you can move on to the next slide, please. So on the flip side of that, we've got subcontractors. So subcontractors are simply a person or business carrying out construction work for a contractor. Again, the legal structure is not important here. Could be a limited company, partnership, or sole trader. The key point from CIS perspective is that the payments they receive will be subject to deductions unless they qualify for gross payment status. But I'll come on to that in a little bit more detail in a moment. If we move on to the next slide, please. So one point that's often overlooked is that businesses can be both a subcontractor and a contractor at the same time. For example, a company might undertake work providing for a larger contractor whilst also engaging with subcontractors. So in one transaction, they're acting as a subcontractor, in another, they're acting as a contractor. The reason that this is important is that they will need to comply with both sets of obligations. We quite often see businesses that may understand the subcontractor side of CIS, but they haven't fully appreciated everything they and their responsibilities as a contractor. Move on to the next slide, please. So as I spoke about right at the start, CIS is essentially HMRC's way of collecting tax from certain payments made within the construction sector. It's important to note that CIS is a withholding tax. It's not an additional tax. So it is tax at source through invoices and withheld, but this can be reclaimed. Of course, the impact of this will be cash flow impacts on the subcontractor having sort of tax withheld. Self-employed subcontractors suffering CIS deductions. This can be reclaimed when they file a self-assessment at the end of the tax year. If a limited company, the default route is that it can be offset against the company's PAYE and NIC liabilities. But if there's a surplus of CIS deductions left over at the end of the tax year, or if the limited company doesn't have any employees, these can be requested to be offset against the corporation tax bill. There are other options to get these withheld taxes back, but the ones I just spoke about are sort of the most straightforward route through HMRC. So to quickly remind ourselves of the deduction rates that are on screen now. There are three options. One end, we've got gross payment status when no deductions are made. So you have to register and meet specific criteria to get gross payment status. And then we've got standard CIS deduction of 20%. So that's for subcontractors who have successfully verified through sort of HMRC portal. And then finally, we've got the higher rate of 30%, which generally applies where HMRC can't verify the subcontractor's detail. So for many businesses, particularly growing subcontractors, gross payment status is pretty valuable because it avoids any tax being withheld before they've got a chance to sort of paying of their own liabilities. Move on to the next slide. So recent changes, if you move on to the next one, please. So the first recent change that have come into effect. So historically, some some contractors would only submit CIS returns, monthly returns they've got to submit as part of their obligations when they had actually made payments to subcontractors. So we had an example of HMRC trying to apply a penalty. I'll talk about the penalties in a moment, to a contractor for not filing their sort of CIS return. But they had no contractors within that period that they were engaging. So we were able to respond and get the penalty removed. However, this is sort of not becoming the case from now on. So from April 2026, HMRC now expects contractors to account for every month, even if they had no payments made to subcontractors for a nil return. So each month they're either going to be submitting a return showing payments, submitting a nil return, or they can notify HMRC that they're inactive. So what contractors can do is submit a 6-month inactivity request through to HMRC to state that we're not actually going to be engaging any contractors for 6 months. But basically the message is pretty simple. Doing nothing is no longer a compliant option. HMRC want to hear from contractors every month, really, regardless of whether payments have been made. If you can move on next, please. So penalties. So unsurprisingly, there'll be penalties for this. So the first, if they haven't filed within the deadline, each month the first penalty is £100. It's generated automatically, and we've seen HMRC go quite strongly on this. I think they're probably automating penalties if they don't receive anything. And then second fixed penalty for £200 for next month. And then after 6 months, this can be a tax geared. So it'll be 5% on any liability which should have been shown on the return, or a minimum of £300. So that can increase the sort of the charges quite significantly. What's interesting is that sort of expect that many of the penalties we'll see over the next year won't arise because businesses are intentionally ignoring the rules. It's more likely that contractors probably aren't aware of their filing obligations have changed, and that they actually need to be constantly submitting returns. So it's quite an important message to be getting out to clients. Next page, please. So the other sort of development that HMRC, and probably the most important one really, is HMRC's continued focus on tackling fraud within the construction sector. So for most legitimate businesses, the key takeaway is not actually the fraud itself, but the expectation around due diligence. So making sure you've got checks in place throughout the supply chain. HMRC are increasingly expecting businesses to understand who they're dealing with to carry out appropriate checks. The legislation specifically is going to be targeting sort of issues such as suspicious cash payments, inflated material costs, and failures to carry out status checks. So it's really important sort of to be going beyond the paperwork and actually focusing on what's going on in practice throughout the contractual chain. We'll move on to the next slide. So the CS fraud prevention consequences is sort of getting this wrong, getting much more severe now. Where HMRC believes a business has knowingly entered into transactions connected with fraud, gross payment status can be removed immediately. Previously, a business could reapply after 12 months of getting their gross payment status removed. So this is obviously quite important, whether if you're a contractor and a subcontractor, just to put it into perspective. But now this period of reapplying has increased to 5 years, which is quite a significant difference, and obviously severe cash flow impacts on that, which obviously is quite negative. On top of that, HMRC can pursue the lost tax and apply significant penalties to the businesses in connection, so on the top end. And also, they can also look to pursue directors personally. Not sure how this is going to happen in practice, but that's what they've come out and said. So due diligence is obviously becoming very important, not just both for tax, but for a commercial perspective. If we move on to the next slide, please. So I thought it'd be useful to briefly share some of our sort of experiences with registrations for sort of contractors, subcontractors, and gross payment status recently, because we've been spending quite a lot of time sort of recently doing that. The common themes of this have been delays. So communication be quite inconsistent. There's not really a dedicated route to HMRC for these applications rather than the online portal. There's no real direct email address. You can call up, but it can be quite frustrating because sometimes advisors aren't quite sure of what their sort of the obligation should be. So what our advice would be with that is to sort of start the process earlier than you think you need to. It's particularly important when you're applying for gross payment status, just in case there's any delays that would impact sort of the cash flow. And also HMRC have got a post granting. So once you've been granted gross payment status, if you've applied for gross payment status, they'll come and review within 6 months of getting it, making sure you're being compliant and meeting sort of all the obligations and there's no issues there. If not, then they will sort of take your gross payment status away and you won't be able to apply for another 12 months due to that. We've also seen some instances from clients recently where sort of they might be impacting commencement dates, i.e., they've engaged a contractor before they've actually been given contractor status when they make the application, which has resulted in automatic penalties. So, which then you've got to go and argue back to HMRC. So, sort of being accurate and making sure your details are all right is really important. Move on to the next slide, please. So before I finish, I want to sort of touch on some of the areas that we've seen HMRC focusing on recently in compliance reviews for some of our clients. So the number one issue we're seeing at the moment is materials. They're sort of going really quite strongly on checking on materials. So HMRC regularly are asking sort of businesses to justify material costs and provide evidence supporting those figures and that there are no inflated material costs that are being paid. So materials have got to be paid sort of at the rate they were bought rather than being sort of inflated and getting a profit element from the subcontractor. We're also seeing inquiries around mixed contracts where labour and materials are sort of put together, as well as questions around whether particular activities actually fall within the scope of CIS in the first place. So HMRC may be arguing that CIS should have applied, whereas the client said no, it shouldn't. So there can be some sort of back and forth there. One thing we've also noticed recently is that with inquiries, HMRC will start quite narrow. For instance, if they're looking at materials, and they'll then try to expand that as the review progresses. So it's important to sort of manage those responses really carefully, ensure that the information that you're providing and going back to them with is sort of accurate and proportionate. So recently, we supported a client where their contractors had claimed significant materials costs within their invoices. HMRC opened a review and initially requested evidence supporting those material cost deductions. As the inquiry went on, the scope widened quite considerably, and the additional information they requested from the sample, so it was initial sample that they looked initially, and then they wanted to look back a total of 6 years of all the materials rather than just the sample selected. So this was obviously quite a significant time-consuming burden on the business to supply this, and it would also potentially open them up to a much wider review from HMRC. What we did, we pushed back to them, tried to keep them on track and said, look, you've selected this sample, give us a bit of time, let us get the full complete data for the sample. We would then review the contracts, invoices, materials, all the payments within that sample. We were able to demonstrate back to HMRC, being quite firm with them and not letting them get away with sort of wanting to look through 6 years, and providing their original sample, giving them everything they wanted, and demonstrated that everything had been calculated correctly and that there was no issues. Eventually, HMRC agreed to drop the inquiry in total. So the lesson learned from that one is to be firm with HMRC. Make sure you're communicating correctly and ensure that your clients have got good record keeping just in case. So that brings me sort of near to the end of my presentation. Probably my key messages would be from this, make sure contractor clients are aware, monthly filing obligations. Don't assume CIS is just within traditional construction businesses. And given HMRC's increased focus on compliance and fraud prevention, now's a really good time to sort of get your businesses ready, documentation, due diligence, sort of getting on top of that early. But yeah, that's all from me, Marie, I think.
Thank you very much. That was absolutely fascinating. And judging by the amount of questions that we've had in, I think most people felt the same as me. So we've got lots of questions and a relatively short amount of time. So I'm going to maximize how many we can get through. So I'm going to kick off with a question that's come through on Q&A. So the question reads, we have a client who has a contractor who will not provide monthly certificates and will only do one per year. There used to be a £5,000 fine for not doing this. Is this still the case?
Could you repeat that again? Sorry, Marie.
Sure. So the question reads, we have a client who has a contractor who will not provide monthly certificates and will only do one per year. There used to be a £5,000 fine for not doing this. Is this still the case?
Yeah, so I mean, without looking into it in more detail, there would definitely still be a fine if they're not providing certificates per month. They should be doing that per month, not just one at the end of the year. That's part of their obligations. So, yeah, that's definitely one that probably needs a bit more of a look into, and quite a surprising sort of way to be doing it, to be honest.
Okay, great, thank you. I guess if the person who has asked that question would like some more information, then if they drop me a
Absolutely,
note, I
yeah.
can
Feel,
make a
feel free to
connection.
follow up my contact and yeah,
Sure.
look into it a
Yeah,
bit more. No
we'll pop
problem.
those on the screen later on. Great. Okay, right. Moving on then in that case. So, um, Damon, quite a few on VAT here. So, are there any specific deadlines to be aware of for opting to tax?
So yes, the answer to that is so. Um, the revenue will only take the option to tax from the date that it is made and notified to them in writing. They will, under discretion, allow that to be backdated for 30 days. They will not allow it to be backdated any further unless the business has evidence that it had opted to tax and had been charging and accounting for VAT on the supply. In those circumstances, there is a possibility of applying for what is called a belated notification. But if they've not made any supplies yet, and they haven't opted, and they then want to do so, as I said, it is only applicable from the day it is notified, or maximum at revenue's discretion, 30 days earlier.
Okay, great. Thank you. I think I'm going to stick with that theme actually. So the next question reads, can an option to tax be made on residential accommodation?
No, is the answer to that. An option to tax can be made on a building that is non-residential at the time, and there are some circumstances where post-residential buildings that have been residential in the past but have not been residential for 10 years or more lose that status. So an option to tax can be made, but residential accommodation is either zero rated, as I say, in the circumstances when it can be when it's new. Alternatively, it is always an exempt supply. Um, if you can opt to tax a building that has mixed commercial and residential, and the option to tax will only apply to the commercial part. So, for instance, if you have a shop or retail unit on the ground floor with flats above, then the option to tax will apply to the ground floor, but not to the residential flats above. And then there's can be nice complicated calculations for reclaiming VAT on construction works that cover all of the property, such as repairs to the roof, etc. When you're trying to work out how you split the VAT recovery on the bits that's relevant to the exempt and the bits that's relevant to the taxable.
Okay, great. Thank you. Options to tax does seem to be a bit of a theme coming through in the questions, but I'm conscious of time. I do have one final question that I'm going to put to Aaron, though. Um, are there any particular factors that seem to increase the likelihood of HMRC opening a CIS inquiry?
So it's a good question. HMRC don't sort of publish a definitive list, but from our experience, large material costs are often the sort of the attraction. Any low-hanging fruit that basically HMRC can see, look at and say, okay, you've got real big materials costs, let's have a look at them. We've also seen an increase in property investors. So whether they're investing in a property or they're property development developers, and whether or not, what the distinction is there, they'll sort of go after property developers that might should have been considered as property investors. So that's quite an interesting one at the moment that we're dealing with a few cases. And then also where there's sort of employment status, it's related to CIS, but where they can, look at the employment status. For CIS, you've got to tick a box to say you've done sort of employment status checks, but it's quite an easy tick box to do, and people just sort of don't really consider the implications of ticking a box. So HMRC can look at that and say, okay, well, what employment status checks have you actually done? tends to be quite little. So then they can argue that, okay, well, there's some issues here. They should have been considered as employees for tax purposes. But yeah, I think the key takeaway from that is really that HMRC will tend to focus on the areas they believe sort of a greater sort of tax leakage. They'll focus at the areas that got the higher numbers and where they can easily argue points, to be honest. But yeah, nothing definitive.
No. Okay, great. Thank you. I'm conscious of the time and that we need to move on to the next part of the session. Damon and Aaron, thank you so much for coming on. It's been great, and judging by the number of outstanding questions that I've got for you, hopefully everybody else that's joined us today feels the same. For those people that have asked questions and haven't managed to get through them, I'm going to package those up and send them over to Aaron and Damon after this session, and they will come back to you directly. Thanks, guys, for coming in. It's fair to say that we'll be back in touch to get you back on very shortly. Right, so moving on to the next part of our session then in that case. So this is something a little bit different that we're going to do today. So I'm very pleased to be joined by my colleague Sam Phillips from K3 brand K3 Advantage. Sam is joined by his colleague Jessel Fernandez, who I think hopefully will appear on camera. There he is. Yep, great. Okay. Just to get us going, Sam, normally I would introduce you, but do you want to introduce yourself here?
Yeah, we'll do. Thank you, Marie. I'm just checking you can, it's coming through okay. You can hear me?
Yep.
Perfect. Well, yeah, good morning, everybody. I'm the founder, managing director of K3 Advantage, and my background is quite varied in that I started in our sort of family business where we took it to market through private equity. So I guess I've seen things through different lenses. I was obviously previously a partner of a top 20 accountancy firm as well. And so having advised businesses, both buy side, sell side, founding a business, which was obviously grown as part of the K3 Advisory Group, I can sort of bring a really interesting sort of perspective on the importance of data, because it was the one thing that when we went through our transaction as a family business is the one thing we really struggled with. We had a good business, it was profitable, it was growing, but when the questions came through due diligence, we couldn't answer them in the pace and the detail that we needed to, and that institutional investors expect. And then seeing that through partnership, accountancy practice, seeing changes as a partnership grows, and the importance of having the right data is something that we're just seeing more and more of. And now as AI is being thrown into the mix as well, how are we adapting? How are we keeping up with the change in innovation and the technology that's available? And that's something that with that Advantage, we've developed a data platform, IQ, that we're going to sort of show a little bit of today. So yes, a good opportunity just to talk about all those things in my experience and how I think it's relevant for those on the webinar today.
Great. I'm going to tee up the session in a second just to get us going. Do you want to just do a very quick introduction to Jessel, who is going to help support us through we're going to do our session in Q&A style today.
Yeah.
Jessel is going to help us out. Do you want to just do a quick introduction?
Absolutely. Yeah. And so Jessel's in our data team has been instrumental in the development of IQ, but has also worked in a top 20 accountancy practice as well. So qualified accountant, assistant manager in our team, and actually has worked, on financial due diligence projects as well. So really, really good perspective to add to this webinar.
Great stuff. Thank you. Okay, so let's kick off then in that case. So today we're going to be talking about a challenge that I think most professional service firms will recognise. So over the last decade, you've invested heavily in systems, reporting tools, and dashboards. Most firms now have access to more data than ever before. And yet when you speak to the leadership teams, many still struggle to answer some fairly simple questions, such as, are we performing as expected? Where are the risks? Where are the opportunities? And most importantly, what should we do next? So today, whilst we will be talking about some tech, it isn't only about tech today. It's about why the gap between data and decision making still exists and what firms can do about it. So just to kick us off, I'm going to ask the team in the background to pop up a poll on the screen now. It is just for fun, but we are interested in your views on this for everybody that's joined today. So the question is, what's the biggest barrier to better decision making in your organization? Please do get involved. It is just for fun, but we will be sort of drawing down on the your responses and sort of considering those throughout today's session. We'll just give that a couple of seconds. Okay, right. Let's hopefully everybody's had time to mark their vote. Have we got any votes? There you go. Okay. Thoughts on those, Sam? Immediate sort of
I mean,
thoughts?
I think it doesn't surprise me that it's a real broad vote. The one that I think I was expecting to be a little bit higher was limited time and resources, because I think everyone wants to have more data, wants to have the ability to make quicker decisions or better decisions or more accurate decisions. It's just the time, because if you're running a business, if you're focusing on client service delivery, then it's time and resources becomes a real challenge. And of course, sitting across multiple systems, it's something we see time and time again. Lots of data rich, actually, I think now more than ever. But trying to draw out the right insight from those multiple systems and bring it into one place is super challenging.
Yeah, great. Thank you. Okay. It might be that we draw back on those results later on. So if the team in the background can just be ready to reshare if we need them, that would be great. Right. So let's move on then. So Sam, we've had, as we've just sort of covered off, we've never had more information and data available to us than we do today. So why do you think so many firms still struggle to make confident decisions?
So I think it's the key point of there's so much data, and where it's on different systems, you're trying to draw it from different places, different people will interpret it in a different way. You've got multiple versions of reality, and just by having monthly management accounts or report, just having I've got some reporting, it doesn't automatically create a clear understanding. And so a really good example, and I've seen it in real world example, is you've got three partners coming into a
Looks like we might have just lost Sam for a second. Let's just see if we can get him back, if you can just bear with us a second. Okay, Jaisal, have you got any thoughts on that whilst we try and get Sam back? Is Sam back now? Oh, sorry, Sam, you're back.
Okay.
Apologies, not sure my application just crashed and restarted. Can you hear me now?
Yeah, I can do. Yeah.
Great, fantastic. Apologies, I'm not sure how much you heard when I got cut.
Do you want to start over?
Yeah, what I was really making the point on was the importance of having a real consistent metric. And so was giving was three partners coming into a meeting, had it literally last week, where they were coming with different interpretations of what profit was, and the profit that they were being judged upon, what they were being held accountable to, rather than having a clear, defined framework. And so, yes, there might be reporting, but if you haven't got an aligned framework and you're pulling it in from different sources, there might be lots of data, you might have some reporting, but it's not really telling the right story and enabling you to make the right decisions.
Thank you. So do you think that do you think firms generally realize that they have an insight problem, or do you think that they've got a reporting problem?
So,
and I guess to follow on, what's the difference between the two?
Yeah, so I think usually they realize that there's an insight problem before it's too late,
Right.
because perhaps the reporting isn't telling the right story, and so again, I come back. I use that partner example just a moment ago, but another one is sort of how do you group your reporting? Is it by service line, or is it by partner? And I suppose they will both tell different stories. If you're cutting your customer revenue by partner or by service line, it might say different things, and we'll bring an example up in a moment. And it's at that point you go, well, I thought my reporting was fine, but it's too late once you've realised, oh, hang on, I've actually been interpreting this data in the wrong way, and therefore you then realise there's an insight problem, and you've then got to shift and got to change. So it's the challenge isn't sort of again, I come back to not collecting the data, it's actually turning it into actionable decisions.
Right. So I guess the challenge isn't collecting data, then it's actually turning it into those decisions.
Absolutely, it is
Right. Okay.
exactly.
Got it. Okay. So, right. So let's move on then in that case. So I guess for those who've joined us today, what are the warning signs, Sam, that suggest that they might have an insight gap?
So the key things is typically around slow reporting cycles. So if you have to wait until the middle of the following month before you have your management board pack or your management accounts, that's out of date. And typically there might have been something that happened during that month that needed to be actioned very, very quickly. Some might say, okay, well, I'm monitoring cash in the bank. That doesn't tell a full picture. And so you need to have expedited processes to bring that forward. Especially if there's spreadsheet dependency, which it's not collaborative, it can be prone to error. And also, if you've got one individual that understands how the Excel sheets and the board pack have been prepared, if there's an illness or there's leave or someone leaves the firm, you've got a dependency issue. And so as a result, you're then not going. They're the only one that maybe understands how the pack is pulled together and how the allocation is made. And as a result, then you're going to have an insight problem. And that then just heightens the risk of conflicting numbers, having a different interpretation of what profit means. If you've got, a clear, defined framework, then that's going to make that a lot clearer. And as a result, you're then going to avoid lengthy discussions around accuracy. So yes, again, lots of reporting, but limited action. And this is typically caused from disconnected systems, inconsistent KPIs, actual core data quality issues. Maybe it's over reliance on instinct. There might be a bias, particularly if you sort of a partner in the firm for a long time, you think, well, we've always done it like this, so it must be right. And I guess then it can cause you a lack of accountability and no one really owning the numbers.
Great. Okay. So Sam, you've worked recently with a number of professional services firms on helping them, I guess, translate data into, decisions and sort of actionable, forward-looking insights. Is there anything to sort of draw down on from the work that you've been doing there that can sort of add to the conversation?
Yeah, I think I come back to there's a firm that we're working with that is transitioning from an office-led P&L model to a service line P&L led model. National firm have been doing it sort of in that office-based way for a number of years, but given the size now of the firm, they're not sort of I think they've identified that by going by service and being more sort of specialized in those services, from a strategic perspective, they feel it's the right decision. What that brings is, okay, how are we reporting and are we getting the right data to back that up? Because what that has been showing is certain offices were actually not performing as they expected, but actually when they broke it down by service line, those individual service lines within in the offices, they could then see which ones were profitable and which ones weren't, and maybe there's better use of resource across the country and pooling resource in a better way. So hopefully that sort of answers your question, Marie, in the sense of that it's a real life example of having the ability to report in a clean way has enabled them to sort of shift their strategy now to focus on how to increase profitability.
Right. Okay. So it's probably a good point at which we sort of jump into looking at sort of the impacts and sort of, I guess, what the impact that poor visibility has on professional services firms, and I guess the cost of that sort of lack of visibility.
So
any views on that?
Yeah, absolutely. The first thing is missed opportunity. So let's take pipeline. Really having a really sort of well documented sales funnel that identifies. It's not just about, everyone says data. It's a financial data. Actually, having a really good sales pipeline, understanding where the opportunities are coming from, how you're following up on those, keeping really good governance with a CRM system of sorts to be able to report. So when you're forecasting, you can start to see how much of that is made up of pipeline opportunities. What's the gap that I've got to find in order to hit a forecast or a budget? Again, that's pulling in from a separate system, not just the accounting system. So if you don't have that visibility of your pipeline and understanding where you've got to get to hit your forecast, then there's real missed opportunity there. Again, poor visibility means you're just going to delay decisions. We see it time and time again, where board meeting to board meeting, month on month, there's a discussion about making certain investment decisions, but because the data hasn't quite been pulled together, again, a firm was trying to really consolidate all its time cost data into a unified form so they could start to understand recoverability levels and therefore whether they need to recruit, because what's our recoverability and therefore what's our capacity. But because they didn't quite have the data in the right format, they delayed recruitment. So again, delaying sort of those critical decisions to grow the business.
Okay. So sorry to interrupt you. So you talked about recruitment there as being sort of, I guess, an area where data can impact on, making sort of potentially business critical decisions. What other areas are there that this sort of poor visibility creates, I guess, a prolonged decision making around sort of specific areas?
The other key one is around pricing recoverability of time cost, and which therefore is margin erosion. And so if you don't have the visibility of profitability levels by customer or by clients, then how do you understand how to drive further growth within a client? Whether, let's say, if you take a project for a client and you think, okay, we're going to invest some time to develop the relationship, but you didn't have visibility that the work you'd already done had been low profitability, would you have taken that decision to progress it further? Because is that the right customer to do it with? Actually, should you focus on other clients where you can see, yes, I've got really good profitability with that client. I can afford to take a risk or invest in the relationship to do more with them, which then can build out more opportunity.
Great. Okay. So we've spent a bit of time talking about the problem of reporting and poor visibility and how it doesn't always support and enable great decision making. So should we make this a bit more practical now?
Yeah.
So
Yeah.
should we talk about and maybe have a look at what good visibility actually looks like from the leadership team's perspective?
Yeah, that sounds good. I mean, just if assuming the technology is all good, can share screen, and we can talk through. I'll hand over to Jess in a moment. But this is where we've developed IQ, which is something that we just want to sort of give you an example of how I think we're seeing it's helping our clients, and how I think it can help some of those on the webinar today, and also inform you for good discussions with your clients as well. So if I just want to share screen just to bring that up.
Is it sharing the right screen? Sorry.
Yeah, that's right.
Perfect. There we are.
Yeah. So this good visibility means if we go into just we want to go into our sort of fee increase.
I've lost Sam there. If I just quickly take over, Sam gets back. So what does good visibility look like? And this is sort of an example. Just to set some context, this is a professional services firm who came to us asking for more visibility on their data. They had, like Sam mentioned, like every other business, lots of data, but it was sort of in different places. It wasn't connecting to each other, and it wasn't talking to each other. And so our task was sort of bringing that together, and this is one of the results of that, and this is one of the most important areas, which is sort of your fees and time costs. So here you're looking at your WIP, so your work in progress, and the fees against that, and what's that meant as a write-off and a shortfall percentage, and how your fees are sort of increasing year on year. But the great thing about this is you can break down your top line figures, so you can look at it by sort of service line, team sectors, partners, your matter type, what type of engagements you're doing. And the great thing about this is it is self-serve analytics. So everyone has access to this. So everyone can be looking at the same thing, but you might be looking at if you're a partner, you might just want to be looking at your data, so you can filter the whole thing to look at yourself, how you're doing, what service lines you're involved with, and how you're comparing against an average. With this particular business, they had some objectives that they wanted to go through, and they set some filters and actions that they wanted to look at, and you can see those there. I won't go through all of them, but the idea is that everyone has access to the same system or the same source. It's a one-stop shop sort of for everyone. So when you're going into this board meeting, like Sam said, you're not coming up with 3 different numbers, and if you are, there's a real reason why. It's because someone's looked at a different thing or whatever it may be.
Okay, Sam, I think we've got you back now.
Yeah.
Should we just take a step back? So do you want to just explain what we're looking at on the screen here? So I guess this is your system. Does this overlay onto other systems?
Yeah, the easiest way to describe it, it sort of sits like a sort of a layer above all of the systems, and it's sucking the data in. And then, and in all those different formats that it gets from accounting system, practice management system, I mentioned the importance of pipeline, CRM, or maybe it's HubSpot or a similar type of CRM tool, and then pushing it out in a unified form. And so what it means is that you've got a single source of truth that everyone understands, that everyone has clarity on, and it's simple. So this is something that through my career I've seen so many times. The issue is the data is there, it's just not being used in the right way or being interpreted in the right way. And so that's why we developed IQ, was to create that. There are PMS tools that will probably give you WIP information, recoverability data, of course, that typically they're a little bit clunky, but don't talk to the accounting system. And so this is why we wanted to introduce this. So actually, and then you can drill down and really start to understand the drivers. Yes, it's giving you some outputs, but you can start to really drive down, depending on who you are in the firm and what your role is and what the expectation is. You can set parameters, triggers, depending on what you want to see. And so ultimately, this is going to give you faster decision making because it's instant. You're not waiting until the middle of next month to get the data. You're getting it right away, and it refreshes every day. And so at that board meeting, you will have the data at that point in time, which we're just seeing is it's speeding up decision making and helping businesses really grow.
Okay, so what we're looking at here is the data that you've been using with one of the professional services clients that we talked about earlier on that you've been working with recently.
Yes, exactly. And just for this is obviously a sensitized, anonymized data set. Just to be clear, just so everyone's aware of that. Yeah. We've sort of put the sort of dummy data in exactly the same sort of outputs, but just with dummy data. Right. And this is one where, again, I come back to that point where they're transitioning from office-based P&Ls to service-led P&Ls. This is the type of model that we've used. So now they can still flip between the offices, but they can flip between the service lines and very, very quickly can see what the drivers are of each.
Right. Okay. Got it. Okay. So let's move on then in that case. So you've worked with quite a lot of firms over the years. What do organizations that have great visibility have in common, in your view?
It's all about, it's not necessarily better systems. It's just better use of information, keeping things really simple, having clear ownership, so that it's not about sort of adding more reporting necessarily. It's just simplifying it into one place and being able to have a really pragmatic discussion around what the next steps are to grow, and actually having real clarity on what to do. Time and time again, you see me going from meeting to meeting on, we'll discuss that. Actually, no, start to really make decisions, trust the data. If you don't, I totally recognize it's only as good as the data going in. So that's why it's really important that what you're using, you do trust. Otherwise you go back to instinct, which then creates hesitation, which then delays decisions. And so what I would just say is in all of this is make sure that the data that you're putting in, there's it could be it's a cultural shift. It's to make sure that people really take accountability across the organization for it. It's everyone's responsibility. And so when you're inputting data, even as small as a new opportunity into the CRM system or putting the client details into the practice management system, making sure that data is going in the right way, so that you've got the sector track, you've got all so maybe it's a subsector number of employees in the organization, as much as you possibly can, because then it's going to give you, if you can populate the data in that way, it's going to give you more insight when you're using it, and you rely upon it more.
Okay, so I guess success isn't necessarily just about adding more reporting.
Absolutely not. It's not. It's making sure that you bring it into one place, fewer metrics, but clearer decisions is how I would summarize it.
Right, okay. So I guess one of the things we were talking about the other day when we were preparing for this was fewer reports, but potentially more arguments about what to actually do as a result.
Yeah, exactly. And if you can simplify that so that you're all on the same page and you've got clarity, and I said that's why the dashboarding is so helpful, because everyone's seeing the same view.
Right. Okay, great. So you talked earlier on about the concept of management reports being available mid-month, and that's too late. So let's shift from hindsight to foresight then. So as I've just said, most firms can tell you what happened last month, but far fewer can tell you what's likely to happen next. How do firms go about making that shift from I guess sort of backwards looking to forward looking?
Yeah, I mean, it might be, I think, the easiest way, and Jess, we just to share screen again, to bring another example. So is probably a theme that many guests on this morning will be familiar with. The client lockup and recoverability. That is such a key point. And so, Jess, maybe if you want to just sort of just I can talk to some of the points afterwards, but just give a summary of what we can see here.
So what you see here is your client lockup. So it's your addition of your WIP plus your debtors outstanding. And in the context of looking to the future, you can see this grey line here, which is your prior year lockup, and this blue line being your current year lockup. And you can see that from your historical, your lockup seems to increase as your year goes on, and you're getting to that sort of turning point now where your lockup might be increasing so much that you need to start making decisions about it. And what this dashboard or this page can help you with is preparing for that. Is going into more detail and thinking, what service lines are impacting that lockup increasing. Are there certain partners? Is there certain engagements? And starting to make decisions about how to reduce your lockup. So, lockup is important in terms of cash flow. If in your working capital, and it might look like you're profitable on paper, when you're looking at your bottom line number on your P&L, it might look like things are going great, but when you look at this number and in your bank account, it doesn't tell the same story. So you can again play around with the filters, and you can do some self-serve analytics to get to the bottom of what you're going to action to reduce that number.
Thank you, Jessel. So I think it's, as you can see, this is something that it is a real key theme for a lot of our clients, because it's just the number one priority is cash collection, and it's how do we increase cash collection, how do we reduce our lockup days, and then having this data available gives you the prompt, holds everyone accountable for their individual clients, and if you're looking at taking on another piece of work for a client, but they're still got WIP and debtors are still high, actually enables you to have the right conversation with them before you start that next project to get the cash in, before you spend more time and cost, and therefore more working capital in delivering that.
Great, thank you. Sam, the big thing that's jumping out at me at the minute is I think that we can't continue this conversation without touching on AI. So there's obviously a lot of noise around AI at the minute. It's the big thing. I mean, I was at a legal conference, Legal Tech Talks last week. It was the thing. What's your view on AI and its role?
So I personally think it's really exciting. I think it's something that we have to lean into safely and securely, but really lean into and learn how to use it in the right way. What I don't think we're at is that AI is replacing, accountants and professionals at this point. Absolutely not. I think it's another tool to add capacity and to add speed. And with the right data, you can, again, if you're using the AI on secure data that's robust, you can start to trust it. The more you use it, the more you understand it. If you're sort of what I would call dabbling in it, and you're not sending the right prompts, you're not really understanding how to interact, that's the point you're likely to get hallucinations, or you're likely to get responses that don't work. And so it absolutely will help you identify patterns quicker, thinking about scenario planning. It's an accelerator tool is how I would look at it. But it certainly doesn't replace judgment, and it's super important because of the experience that we've all had on this webinar today. Years of experience, AI doesn't have that. It's a set of outputs on certain scenarios that may or may not happen, but typically human judgment knows best.
So I guess augmented judgment rather than artificial intelligence, is that a fair way of describing it?
Exactly. And I think, but all I would say is, use it with trusted data, lean into it. It's really exciting.
Indeed, it is. You obviously showed, so Jaisal showed a screen share just shortly. Just coming back for a second, in the platform that you've built, is there an AI layer in there?
There is. Yeah, we can bring up on screen as well, because again, it's something that I said I'm a big advocate for AI. I think it's something that used in the right way is super powerful, and we've developed an AI chatbot, if you like, within IQ that you can in essence give yourself self-serve analytics and talk to it as if it was a chat or Claude or something similar. But it's hosted in our platform. It's safe, it's secure. It doesn't hallucinate, and it's only talking to the data that is held in it. So it doesn't go anywhere else, doesn't go externally. And you can start to really, if there's something specific that you want to understand, you can start to talk to it. It can visualize charts. You can then drop that into board packs if you want to. But it's really important to that I suppose people on this call know this is all hosted within our own infrastructure.
Right. Okay.
And you can see here it's talking through it, and suddenly it brings up charts that maybe you don't have in the standard suite. Maybe it's something for this particular month or this quarter that you want to understand. Again, this is dummy data. It's just to give an example of the art of the possible. But really, you can develop it in any way you want to. Great.
Okay. That's this is fascinating. It's the first time I'm looking at this in any real depth. We talk a lot about IQ at K3, but this is the first time that I'm looking at it in any kind of depth. So very interested in this. I expect most people joining us today will feel the same. So let's come back to some practicalities then. I'm conscious of the time and that we probably need to bring our conversation to a close shortly. So if everyone that's joined us today could take one action when they get back to their desks in the context of improving data reporting, visibility, improving to enable better decisions, what would you encourage them to do?
Just create clarity. Give yourselves visibility so you can make decisions with confidence. It's not about more data, more systems. We've got plenty of that. I've said that a lot this morning. It's really about bringing it into a consistent view that creates accountability, that's simple. And I think that's the one thing I would encourage everyone to go away, both within their own firms and with their clients, is that for me is what I see time and time again. It erodes value is when you can't make a quick decision because data is in lots of different places.
Okay, great. So today we've talked a lot about the insight gap that exists in professional services firms. What I guess final question now. So what's the first step in that firms will take in closing that gap?
So if firms have got an understanding of the technology that is available, I think it's sitting down with your IT team, finance team, bringing everyone together to create a real, what I call a digital transformation plan. Because at that point, it's not just about, I come back, not just about the finance numbers, it's about all the data that you've got available to you, and ensuring that that is being brought together in a way that is useful. Otherwise, as you scale and get bigger and bigger, it becomes harder and harder. So starting sooner rather than later is so important, because if you put those processes in now, as the business scales, as it grows, you'll scale, not stretch. I think I've talked about this before. You won't stretch if you don't put those processes in place, and you've got more and more data. You're going to stretch and stretch and make it harder to make those decisions quickly. And so I would say starting it yesterday is absolutely key.
It's the right time. Okay, right. Let me try and sum up in as nutshell as I can manage what I think we've covered today. So what I've taken away is data isn't the challenge, and most firms already have more information than they know what to do with. So I guess the challenge is, creating clarity, visibility, and confidence so that information leads to better decisions. And I guess that the firms that succeed won't necessarily have more data than their competitors. They'll simply be better at turning that data into action. Is that a fair summary?
I think you've summarized it very well. Absolutely.
Perfect. Okay. We've looked at a system today, Sam. If there are people on the call today that might value also having a look at that, how do they take that forward?
Please, reach out directly. We can set up a demo. Talk about some very specific needs, requirements. What you saw today is just one example. There are different levels and the functionality of IQ, from a sort of basic version to a full bespoke setup. And so it really is, we can get a demo set up if it's for firms on today, or for their clients as well. Very happy to set that up and run through any questions.
Okay, we are going to share contact details on the screen towards the end of this session, just as I wrap up. We will be sending some information out about this, but that will be probably middle of next week. I think there are a few people who have asked for the slides. So the slides that accompanied the VAT and CIS scheme session earlier on have been put into the chat several times. I know that some people have looked to have had some trouble downloading them. I will send those out via email later on today. So just bear with me on that one. There aren't any slides to accompany the second part, so the conversation that Sam and I have just had, but we will send out some more information about that next week. So I guess all that's left for me then to do is to wrap up. So just before I go, I'd just like to flag a couple of forthcoming CPD events for you. So next Friday, 3rd of July, we've got AI for lawyers and accountants, and that is full CPD accredited. We then take a short break over the summer, and we'll be back on the 4th of September, again with a CPD accredited session on accounting issues. Don't forget, you can watch all of our recordings of previous webinars on demand. They're to early 2025. And I think all that's left for me to say is thank you very much for joining us on probably what is a very warm and sticky Friday morning. Thanks so much for you all joining, and I hope you all have a great weekend. Thanks everybody for joining us.
Thanks everybody.
Thanks everyone.